Welcome, and thanks for tuning into KBRE Podcasts. Here, you can find topical discussions, industry commentary, and more. Today, Head of Sovereigns Joan Feldbaum-Vidra and European sovereign analyst Ken Egan update us on major central monetary policy and implications for sovereign credit. Stay tuned to learn more.
Thank you for joining us for today's latest Sovereigns podcast on global central banks. We thought it timely to reach out to our listeners to provide a comparative update on what globally important central banks are doing and the implications for recovery. These themes, of course, are important for us to follow at KBRA because of the implications across asset classes. The central banks we will cover in today's discussion are the ECB, the Bank of England, the Bank of Japan, and the Fed. We will also intersperse our comments with our views on the implications for global economies in the EM space, emerging market space that is, where there is a lot of impact of external dynamics. But a pause is relevant here to just provide some backdrop as well as some relatives. This is no news to any of our listeners, but global central bank partnerships with sovereign treasuries are perhaps the most critical ingredient to the successful management of this crisis. The aggressive policy actions by globally important central banks at the outset of the crisis permitted central banks across the world to lower rates. In addition, the support low rates have provided to the world's advanced economies has a critical bearing on the recoveries of smaller economies across the globe. Can you imagine a situation where the US Treasury borrowing was constrained and what that might have done to the US economy and in turn its demand, which is of course critical to global demand? The systemic importance of the Federal Reserve Bank cannot be overstated. Some details may help guide this discussion. Fed assets, let's start with that. Fed assets stand at about 35% of GDP right now. They were about 10% of GDP in 2009. Bank of England, their assets stand at about 45% of GDP now. They were under 5% in 2007 and about 24% in 2013. On to the ECB. ECB assets stand at about 60% of GDP now, double the amount in 2012. And the Bank of Japan, its assets stand at about 130% of GDP. That number was about 20% of GDP in 2007 and 30% in 2013. A lot of numbers here, but the main point we want to draw is that there's been a lot of buildup and a lot of built-in flexibility. Now with that, let me hand it over to my colleague, Ken Egan. He's a bit of an ECB and BOE watcher himself. He came to KBRA from the Central Bank of Ireland and before that worked on the buy side and straddled US and EU markets. He covers a lot of sovereign credits for KBRA in Europe and he's a great contact for all of you. Ken, let's start with ECB. Please kickstart us. Thank you.
Thanks, John. Well, I guess the big news from the ECB over the last month was the release of its new monetary policy strategy. The ECB announced a new inflation target of 2%. Just to bear in mind, the old target was deemed as close to but below 2%. And I guess this new firm commitment to 2% helps anchor longer-term expectations of inflation, which in this current environment right now is crucial. The ECB will take a symmetric approach to this, meaning an overshoot of 2% will be tolerated, but unlike the Fed, the ECB won't compensate below target years by allowing inflation to run hot over 2% to make up the difference. There's one or two other items here with respect to the strategy review that I'll mention in a minute, but just to assess where we are now and where we're going in the euro area. For some background, through the pandemic, policy action of the ECB has helped smooth financing conditions, kept borrowing rates low, abundant refinancing operations ensured that rates didn't blow out around quarter ends, while spreads between sovereigns consolidated and curves shifted lower. Lately, we've had high inflation prints in the euro area. But in terms of outlook, the debate is that these figures are what they are because 1, the base effect, 2, oil price action over the last 18 months, and 3, disrupted supply chains. The idea here being that in 2022, the year-on-year inflation readings, which the ECB looks to, will dip as these factors ease. So based on this and looking through the transitionary elements of inflation, could we be in line for even further easing of policy next year as the ECB chases its target? It remains to be seen, and there's probably not that straightforward. There are other aspects of the recovery that could lift inflation, like the ECB's incentivized lending program or the EU's recovery funds. For euro area treasury managers looking at issuance plans, the current Euribor futures curve points to a rate below negative 40 basis points through the end of 2023. So the market believes the lower for longer narrative. However, We know how quickly this can change after each data print. Lately, policymakers are trying to reset market expectations for the euro area. Of course, the other question would be, how relative are higher rates in the short-term horizon, given that the policies of the ECB over the last 18 months have enabled debt offices to smooth their redemption profile somewhat and extend their WAM. When this window of opportunity shuts, you'd imagine most treasury offices will have their houses in order. It's also interesting to hear the comments of Jens Weidmann recently on this theme. He said, we cannot take into account the financing costs of the states and that the ECB is not there to take care of the solvency protection of the states. Just to come back briefly to the strategy review, inflation itself will change slightly, along with a greater emphasis on housing costs from the ECB. While I also just want to mention the ECB's shift towards a green agenda. It'll be interesting to follow and see how this plays out. A greater emphasis on green bonds within the APP could change the composition of market issuance, certainly in the corporate sector, you'd imagine. For sovereigns, we've seen some sovereigns building out their green curves already. In Germany, for example, the UK is planning the same. The demand for sovereign green bonds this year was staggering when we look at bid cover ratios of some of the deals. And it could appear debt managers won't keep up with the demand in this space. The ECB could be the final piece of the puzzle in what will be the most popular talking point in the sovereign bond market over the short-term horizon.
Now I'll chirp in to give Ken a break, and I'll start with the Fed. I'm going to do my best to streamline my comments because there's a lot to say here. As we know, the Fed has been conducting about $120 billion a month in asset purchases, about $80 billion is in treasuries and another $40 billion in agency securities, MBS. It's also been eating up almost all of net issuance in recent months in the treasuries market, partly because of the inflation, and we expect the Fed wants to stay ahead of the curve in rates. Inflation, the latest PCE print was 4, double the 2% target, but there's a lot of tolerance there because of the more flexible employment objective, as we know, of the Fed. Like many central bank policymakers, the Fed has stated that it thinks the spikes are temporary due to COVID and supply-side bottlenecks. But in KBRA's view, there is some risk to that scenario, given wage pressures that we're seeing. And how will this evolve, at least in the US? Well, on the one hand, we have the debt ceiling expiry and the Treasury drawdown of its deposits. But on the other hand, we also have the strong possibility of more fiscal spending and an even stronger likelihood of resolution of the debt ceiling. So the net is we'll have more issuance. KBRA's baseline expectation is that the Fed will announce tapering around year end and start executing shortly thereafter, with upward rate adjustments to follow. Improving non-farm payrolls, and we just had a release last Friday, increases the likelihood of monetary policy normalization. Although the fact that we're still about perhaps 9 million jobs short reduces that likelihood. Also, the second quarter GDP print was very off, and there are uncertainties about the third quarter as well, especially as virus variants seem to be threatening that. So that expectation is not firmly grounded. Now, the Fed is not the largest holder of treasuries. That designation goes to foreigners, and that truism is aligned with the fact that the US dollar accounts for about 60% of global allocated reserve currencies. So all those factors absolutely influence demand and supply. Whatever the case, whatever the timing, it's our baseline expectation that rates will still remain historically low for a long time, and also that the forces keeping inflation low over the long term persist. Moreover, let's remember that accelerating normalization would mean that the economy is doing well, which is a critical factor reducing risk. How this develops will be critical to other central banks. Rate hikes are starting in EMs, several on multiple occasions already due to inflationary dynamics, but this is still very isolated. The ability to keep rates low and to slowly normalize monetary policy towards a new normal of low rates will be critical to their recoveries too. Emerging markets are way more sensitive to inflation because of their histories and also because of the wiggle room of their populations to absorb higher costs. That's much less pronounced than in the advanced world. One thing to note is that the emerging markets are very behind in recovery, except for the large commodity producers. And in general, hastened monetary policy normalization would be inopportune for them. Ken, on to you, the Bank of England. Are you ready?
Well, we had an interesting Bank of England meeting last week, and it appears among the major central banks like the Fed and the ECB, the BOE will be closely watched as it tapers and normalizes policy following this recovery ahead of the other two. You can see how the Bank of England is becoming increasingly concerned about inflation, and they revised up their own projections for inflation to 4% this year. The previous forecast was for 2.5%, and the bank sees inflation of 2.5% for next year, above their target of 2%. In the UK, inflation pressures could persist through a transition period. The margins for a lot of retailers is quite fine. We think pressure is building and the dam could break soon. Consumers will have to pay up in the UK. Some of the big corporate players in the food industry are already citing this. And similar to the US on the labour front, it's a question about attracting staff, which ultimately means higher wages. The BOE said it expects the UK economy will grow by 7.25% in 2021, a fast expansion, while it raised the estimate for growth for 2022 to 6%. Previously dovish policymakers are now making hawkish assumptions. Last week, Bank of England gave an update on its QE outlook. Reinvestments will now cease when the policy rate reaches 50 basis points. Previously, this target was 1.5%. And when the policy rate reaches 1%, the Bank of England will consider selling gilts. The reaction from the market was instant. On Monday last week, the market implied probability of a BOE rate hike by June next year was 50%. And on Friday, it was 90%. Similarly, expectations for the policy curve shifted higher by 20 basis points over a 1-year period. So the market is now anticipating a 2022 hike by the BOE. So all eyes will be on the Bank of England as it plots its course back to normality. The next series of MPC meetings and data prints will be very interesting to follow.
Thanks, Ken. Great comments. Now I'll quickly go through the Bank of Japan. So Japan has struggled for years to get inflation anywhere near its 2% target, and we note its recovery is out of sync with what's going on in the US and China. It's much more delayed. For example, first quarter and second quarter year-over-year GDP prints were negative for Japan. The latest inflation print showed inflation in negative territory, but that's been attributed to technical factors surrounding the reweighting of the basket. Japan has had a negative interest rate policy for quite some time, and this hasn't generated the growth it's hoped for. Plus, the BOJ asset purchase program is at this point institutionalized. So naturally, there's no big sea change in policy and hence a lot less of a boost to the economy. Now, in contrast to the situation in the Fed, my comments earlier, the Bank of Japan is by far the largest holder of JGBs. It accounts for about 50% of outstandings. The Bank of Japan holds a lot more assets than that as well. It's been buying equities for some time, but it's looking towards retrenchment there, concerned about the sustainability of that policy thrust. And it will likely, at some point, become more measured in its interventions. The Bank of Japan is the only major central bank that purchases stocks as a monetary policy measure, and it's a large holder of about 7% or so of the market. One other innovation to mention before I move to the trajectory and implications is a stepped-up orientation to mitigate climate change that is being rolled out by the Bank of Japan. Now, onto the question of where do we go from here and credit implications. One issue with Japan is the really high propensity of households to save, and that's pretty heightened when households get nervous. COVID has made households very nervous, and hence all the stimulus is being parked into savings accounts with little impulse to spend. In addition, in Japan, and not only in Japan, infections are accelerating. And while mortality has fallen, vaccines are still more hesitantly being rolled out. Only about 1/3 of the population has been vaccinated now. And social mobility restrictions are presenting a resumption of normalcy in the economy. So here we have the storm, a huge propensity to save, an asynchronous recovery with other global economies, accelerating infections in the context of a subpar vaccination rate. Well, it's not a surprise that there have been downward revisions to growth forecasts for Japan. It appears likely that the very accommodative monetary policy is here to stay. And subterranean PMI prints also support that thesis. So Ken, I think that wraps up our talk for today. Just want to say we're always happy to be a resource for our listeners. And thank you very much. Ken, do you have anything you want to add here to wrap it up?
Well, I guess just to mention that we think a few actors are yet to play their part in this recovery, but the challenge from a central bank perspective here is keeping a lid on inflation, but also maintaining low rates. This is a balancing act they're facing, and the recent Bank of England decision sort of highlights this. In the Bank of England case, for example, we'll see rate hikes before balance sheets begin to unwind. I guess time will tell whether the central bank narrative is correct and inflation is indeed temporary. Policymakers typically prefer to go unnoticed during their terms in office, but right now they're taking center stage. Thanks for having me today, Joan.
Thank you, and stay safe, everyone.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter @CrowBondRating. We'd also like to remind you that all of our ratings and research reports are at kbra.com. Lastly, please share your ideas for future podcast episodes or any feedback to media@kbra.com. We hope to see you next time.